Hello everyone, welcome to Red Summer Holdings, a real estate partnership comprising of 8 owners, Tochi, myself Zoe, Ramad, Charles, Ikechi, Chima, Innocent, and Ike. Here we discuss the evolution of our business, which shows you how group economics can be successful in regards to real estate. If you believe there is value in this information, please like, comment, share, and subscribe. With that being said, let's get to the content you've all been waiting for.
And then now we can talk about the process with getting lending and our lending relationships. So we've been dealing with two primary ones so far: the national lender, which is like quick and easy, but more expensive and significantly shorter terms, like a 2-year term, as opposed to the 30-year or 15-year. And then the community bank, which has wanted a lot of information from each of us individually. So the stance that I had originally is like, let's get going, let's keep this momentum, let's do what we got to do. But it seems like no matter how fast I find myself and find us like going, there's going to be reason for it to just like take more time. And so my posture on it is sort of changed, because in the time we'll be adding to our funds anyway. So the rush is there, but it's not there, because we don't have to buy in this region. We don't have to buy the properties we think we want to buy yet. And more importantly, I would like for us again to have a base hit for the first property. So I want something that's not going to be a problem, where it's going to be a lot of capex and a lot of day-to-day going back and forth. I want something simple and easy. And so with that posture, I've slowed down on the pressure to get this in, do this thing. And now it's more like, this is the list, this is the things as they come, we'll fill them in, we'll do what we need to do. So do you guys have any questions or any thoughts on that?
Honestly, like going through the process, kind of levels to you, right? As you go through the process to start, okay, this is a little bit challenging here, there's a roadblock here. And so I think from me hearing what you're saying is that having gone through this period is a good level setter for us as we're moving forward. So I think, yes, it does make sense. And I mean, I've been doing some independent research, as well. And right now it is a little challenging, but so I started looking at loans for from credit unions. Credit unions are not the ones I'm looking at are not doing anything with investment properties. They're not doing anything with investments. They're only doing residential, residential property. If it's your own home that you're buying, then they're doing that. But investments they're not doing. But you can still get stuff though. It's just a little bit little trickier.
Yeah, and I get the feeling that for the community bank that we're dealing with, that we're like sort of on the back burner just because of everything so far that he's doing. He's got to do it 8x, like the underwriters have to underwrite 8x. And so like until we get all our stuff situated, and even then when we like put in a load of things, you have to sift through them and figure out what's going on. So yeah, just slowing down, honestly, just to make sure, because we're not actually in a rush. We're actually only halfway as far, like we're 2 times faster than we originally projected to be when we started out, roughly 2 times, like just under. So we're right on time. Honestly, we're still ahead of time. And so it doesn't make any sense, or makes less sense to strike too early. So there's that. And the second thing is like to get more, to get more relationships. So there's also, in the time that I've been traveling, been contacted by 2 other banks. One is another private lender who hit me up on LinkedIn. And so we like did an initial introduction, and I want to follow up on that. Tomorrow's Monday, so I'll probably do it tomorrow. And then also there's another small bank called Bank of England, which came through on the Zillow, like get financing. When I initially looked, I just clicked it just to do it, and I never followed through, but then they followed through back. And so I want to see what they're talking about too, because there may be some variance in terms of what it is that they require for an LLC or any particular entity to be able to get financing. I know that, like Chima, who has like stellar credit, it's a little weird how good your credit is at this point in your life, especially because I spent my 20s with you and I know the types of decisions we made. In any case, good on you. So there's that, and then there's also, you know, tax requirements. Like Tochi has a question about the schedule tax requirements that we can go over to right after this. But I want to see what it is they're willing to give and what it is they require. Just so like we know with the national lender, they're willing to do the deal. They can do it relatively quickly. They care really not that much information about us. It's just that we'll only be able to secure the property with them for, you know, short term 2 years, and then we'll have to refi, which calls into question property values in the near term, and also our ability to service the debt. Which I did the math. I may have done it wrong, but I did the math and it still comes out. It's just the question is whether at the moment, the question is, it comes down to the fact that like we're paying roughly $5,000 just to get the deal done. And is it worth it to spend that $5,000 to get a deal done that we'll have to start over in 2 years? Or is it worth it to do the wait and the onerous, you know, or relatively onerous application needs to get it done for, you know, a longer term? Do you see what I'm saying? Like there's a push and pull in terms of time, energy, and money that we need to consider.
What were the
for our
closing
deals.
costs on the community bank? Were there any?
The closing costs are roughly the same. It's like I think it's like 5,200. It comes out to for because of the points, which is like 2,200, something like that. And then, you know, the all the other like, and that doesn't include getting an inspector that we would need to do independently, which I'm assuming is anywhere from $500 to $700. So they're both roughly around 5,000, but one's, you know, closing quicker, but on the tail end, you have to start working more. And then one's not closing quicker and getting more information, which, you know, sort of inextricably in this region will tie us to them, because like the impetus or the energy, the incentive to start a new relationship after having done all these things to get into this relationship. Although, you know, if we already have a property in the region, a refi shouldn't be as hard because we already have secured the property. But all those things being said, these are sort of the push and pulls. And at the end of the day, the more time we take, yeah, we don't, you know, purchase a property, but we may be purchasing a property, the wrong property, or a property ahead of time, or in the wrong region, or we may spend more time and energy as well as money on a deal that we didn't necessarily need to. So I think that we'll continue to work with the bank that we're working with, and continue to go back and forth about their needs and what it is we produce for them. I feel it too about the credit runs, because every time you run any of our credits, like the whole point of beginning the entity is to not bother the credit and to not deal with our own, you know, individual, what is it called? The 1.25, the debt to service. So
Yeah.
go ahead.
Yeah, how come? Yeah, it's as a limited liability company.
Yeah.
I feel like we shouldn't be running the credit on. I mean, we don't have any credit history, right? With
That's the problem.
Red Summer. Yeah.
The whole issue is that, which is, you know, my immediate. Whoa, is that the shadow?
Yeah.
The reason why the immediate, you know, my immediate question was like, what's the point of us in the operating in the entity then? And it's basically, you know, the entity has no record. So the entity, to get off the ground, has to lean on our records basically. And then there is a way that we can do it off one person, or I don't think it's one person. I think it's like fewer than 8, because again, since it's a community bank, at closing, it will need to be notarized. All the documents will need to be signed and notarized. And for the guys with property, especially, everybody who's purchased property before, you know that like an individual needs to come. Generally, it's like a guy on a bike. They come with their like notary stamp, and like it takes like, you know, 45 minutes to an hour to sign documents, and then sign documents, stamp, and then that person will take it away. Like it's an actual process. So like to have to do that 8 times and in, you know, 6 different cities across the country is going to be, and this is, you know, mostly because it's a community bank. They don't do DocuSign. It's not, you know what I'm saying? They deal with mostly people in the region anyway, who probably just come into the bank.
Even if
as
those,
opposed,
even if they did, like those, the closing documents have to be wet signatures. So even if they
Right.
could do DocuSign, they wouldn't. And like
Right.
it's funny that you even mentioned that, because just looking at my recent closing statement, like you get charged for that notary coming in. That you get charged for all like the wire stuff, and
Mhm.
so we would get charged, times 8. So like
Right.
a notary maybe costs like $25 to come or $50 to come. For us, that's $200, $400 on that. So we gotta keep that in mind too, and like in those like sort of not hidden, but closing costs that are going to be on that.
Plus breakpoint, plus the time, right? Because that thing needs to be sent back to the bank, and all of them need to be sent without a hitch, or including the time for the hitch. So at the end of it, like our sweet spot is like a national lender who can do at least midterm, at least 10 years, with and then the closing costs at this point, at least from the two that we've dealt with, the two responses we've gotten, is around the same, like around 5K, basically, which seems like a cost of doing business. Fine and fair enough, whatever. But if we can get like somebody who can do deals, just look at them at the cash flow and do the deal from there, that'd be the greatest. And then that extends us, that's on the lending. Then it's in terms of our product. The two things that we have to consider is that the one that does cash flow well is by far the best property in the neighborhood, which is like a no generally for investing. You always want to get you always ideally want to get, depending on your how you want to invest, you want to get the worst property in the neighborhood and then bring it up to par and then capture all the value that you're able to do. Not, say it's already at the top of its value and you purchase it there. And then any issues that come, you can't extend your margin. They're all eating into the margin you baked in when you started. So there's that thing, and we'll understand more about that, or you guys will understand more when you see the photos that I send, that I take and send. And then also the other one, the Hollywood one, it's as advertised. The only problem we have there is that they're selling it as if it's completely occupied, and it's not. So its value currently is based on our analysis and dirty math. I think the one is renting for $650 at 1%. That would give it a value of $65,000. You see what I'm saying? But they're trying to no, well, that's actually, sorry, that's still good value. They're trying to sell it at 50,000. I think the price there is 52,000, and it's got, that's my issue. My issue is I think I'm putting the rent of one on the other. I think the rents for the Hollywood one's like 450, 425, something like that. I don't think it's up to 600, which will give it a value of 45K. Dirty math, if we do 1%, just eyeballing it. Obviously, if both are rented, then that significantly increases the cash flow. But I don't know when both will be rented. I don't know why throughout the time that we've been watching the property, it hasn't been rented, even though they said, it can be rented easily. And I don't know how easily it can be rented because it is a duplex and it's like a standalone. I don't know the way of life out here that well, but like you're basically, that's like a roommate that you're hiring. So you probably care a lot.
Here's a question. It's let's say we kept, raising funds, just doing what we're doing, maybe do even one more booster round sometime early summer. And in the meantime, Ike, you got a Ally credit card with Red Summer, and you started spending on that credit card and paying it off, right? Just to build some kind of credit history with Ally over the next 3 to 4 months.
Access, yeah.
Sorry, Axos, yeah. So for the next 3 to 4 months. So say by June, or we're doing $1,800 a month. Okay, sorry, $1,600 a month.
Mhm.
I mean, let's say by June we get like 10 to 15K more if we do another booster round. Then we'll have mid 30s raised or low 30s. If you go to a bank and say we're going to put 50% down, I think the attitude will be a bit different. We might not have to do and we have some kind of a credit history with Red Summer because we have a credit card, we've been spending on it. We can even buy a big purchase and just pay it off. If someone needs to buy a couch or some shit, just use the Red Summer thing, buy it, pay it off right away. Just to build some kind of credit.
Okay, sorry. The thing is that do we have a credit card with Access? I thought we just have a business savings account. We'd have to apply for a credit card.
Yeah, we just have a business savings account.
And then
we should.
if we apply for a credit card, they're probably gonna want to like credit. They're probably gonna be like income and expenses, like, you know what I'm saying? They want a reason why they're extending credit to you. It's my assumption. I also don't think, I think that if we come with half the spending, is probably like the credit history is probably less of an issue. If you already have half the money, I don't see why. Like, I don't, and it's not like we're not getting lending. The thing is, the only issue is that the closing costs, like what we're trading off is like the ability to get long-term lending with not having given our information. So these people are basically saying like, okay, we'll give you a short leash and really give you an opportunity to develop that credit, but you're on your own after this 24 months. So that means, you know, opportunity to re-sign perhaps with them, get an extension or free agency. Either way, it's like it's the LeBron take, where it's like short term, I believe in my value at the end of this, and I believe my value will go up, which more than likely it will, but you still want the security if you can get it for relatively the same price for a longer term. That's all. And then again, in the meantime, there's not really a rush. At the pace that we're going, we're totally fine, and we're slightly over halfway where we originally expected to be, and now we're already talking about, you know, purchasing. So we're very far ahead of time, to be honest. And I think that I too need to explore more lending relationships, because I personally also feel like if this is the market and this is what we need to do with everybody, then fine and fair enough. But if we don't need to give hella, like, it's not even giving away all our information, because at some point you have to do that, but it's the fact that you need 8 versions of it all the time. Like,
I'm more concerned about the coordination of 8 people on one loan, because I feel like, you know, just the closing experience, I don't, and we're already dealing with, you know, a regional bank that most likely isn't very sophisticated in their communication, you know, across the country, in effect. And so like the timing of the closing, the cost of it, it seems like it may, you know, eat into some of our numbers. If we're already looking at like 5K in closing costs, we're probably looking at another 600 in inspection, appraisal, another 600. So we're looking at about 7K right there in closing costs. I got to imagine that's going to tweak our return percentages, you know, on the deal itself. And so we have to sort of keep that in mind, I would imagine. Just dealing with our price points. And I mean, even if we have like great percentage returns, the dollar amounts are going to be on the small side. So we got to be really conscious about some of those costs that we're going to incur on the front end.
Yeah. I mean, all that said, in order to streamline this process for the long term, and given we don't want to be locked into a specific region of the country, getting a national lender, I think, you know, already said that might be the route to go, that feels comfortable, whether we happen to be in, you know, the Memphis region this time, or we end up in like, you know, whatever, some like Texas suburb the next time, or wherever else we end up. As opposed to having to repeat this process every single time with a regional lender or small bank, because that, like I said, out into the cost every single time. So I can't imagine a small bank won't do the same process every single time.
And to your point, you know, say we just start off with the national lender, and then also build, you know, credit as a company, like you were saying before, you know, applying for a credit card after we've already closed, and using those, like that credit card, to do like the maintenance and repairs and like all the expenses that have to go into real estate ownership over the course of 2 years, and build the credit of the company. And then since we have to refinance out of that national loan in 24 months, start considering those local community lenders at that point, when we've established ourselves in the region, and maybe even having an open line of communication with them throughout the 2-year period will make it a lot easier for us to refinance without, you know, the cumbersome requests of, you know, 8 different credit reports, 8 different PFSs, and 8 different closing arrangements.
Yeah. Also, another advantage, like a national bank will be able to, a lot of things are just automated, right? So a lot of times you can pay your mortgage costs. You could pay a mortgage with like just direct deposit. They just
Yeah.
withdraw it from your bank account, right? And sometimes they'll take points off if you open a, if that's how you pay. They might say, if I will give you a 0.5% reduction in your mortgage rate if you pay for it that way. So I mean, it'll take some work off of whoever's going to be doing it every single month, having to write a check to some bank and send a mortgage check in. It's just done automatically from the Red Summer account. So, I mean, it sounds like there are a lot of advantages, at least
Do
presently, to doing.
do we know the spread or the difference for the actual rates that we're looking at from community versus national bank?
I can't imagine
Or
it's
it's like a
higher than
ballpark?
9.25%. Now, 9.25% seems like a high number. I can't imagine it's going to be
That's too
double
high.
digits.
So 9.25, or let's call it 10, just to be conservative with the national lender. And then what was the rate on, or we didn't get one yet for the community bank?
He said, let me check. I believe it was anywhere between 3 and 8%. But let me check
Yeah.
actually and look
Wait.
in my.
Real quick, okay, what rate did you get on yours?
On mine with the national lender, I got 6.5.
You got 6.5% on yours.
Yeah.
Okay. The national lender.
Yeah.
Okay.
And I forget why, but like right at closing, it dropped down like 50 basis points for some reason. Like it was going to be in the 7s and it dropped to 6.5. I forget why.
Did you
Okay.
open a bank with them, a bank account with them?
No, it might have been because I had just already did another loan with them before, or
Mhm.
I think it's because the property appraised for more than the purchase price ended up being. So I was
Gotcha.
able to get a lower LTV, therefore a lower loan amount
Makes sense.
or
Makes sense.
loan
Yeah.
rate.
I imagine if we
Go ahead.
sorry, go ahead. I was saying if we got to that 50% number or closer by the time this all happens, it will get a much more favorable rate with the national bank.
There's two things though. So like if we're able to raise, which we are, if we spend more, if we're able to hold off, which would equal raising more money, then I'm not sure how much closer we would get to 50%, because all that would mean to me is that there's an advantage in purchasing a even more expensive property. Like there's an advantage, we would probably be able to, at the end of the point we were talking about, purchase something closer to 100,000, which would be more secure in a better neighborhood, generally better returns. So, and also, I don't know that prices here are going up in this region, for example. I don't know that prices are going up, or more so that properties are just getting scooped, because like there's between I want to say 75 to 120,000 in this region. That's like the hottest price point here. Those things get scooped up quick. There's like one that I was looking at for our purchase, which was like 75,000, and I think it's like within a few days of we seeing it. Although it's been on for a while now, because I don't know why. I don't know what the back and forth is, because it was supposed to be all cash, the offer, but it's like a great property and it got caught up like quick, like super fast.
So
Gotcha.
I'm seeing that at that lower rate, most people are just wanting straight cash, right? They don't want to finance. I just want to do a cash buy.
Under 100K for both. Under 100K for the national lender, which again is I should say is a private lender. It's not a bank. So it's like a group of people with money. I think the particular one I'm working with, or I've worked with already, is like Silicon Valley money. And then there's another guy who's a private lender in Sacramento who he just reached out to me on LinkedIn, and I'll see more about him and what they have to offer. But these are private lenders. These aren't banks that can work nationally. You see what I'm saying? So there's a little bit of a difference there in terms of that. It's not like necessarily they offer any services that a bank does. They don't offer, bank accounts. They don't offer credit cards. They probably offer home equity lines of credit, and they probably offer perhaps personal loans.
It's just straight lend. Like my firm has like a division that does the same thing, and it's just straight lending. But their rates are like ridiculous. Like that's not something we'd ever want to deal with. Like
have we considered maybe a third option, which would be, what if we buy something cash and then do a line of credit on that? So we buy it cash, get it, and then we go to one of these regional banks and say, hey, look, we have this thing that's worth 70.
70% LTV will be like $49,000. We want a line of credit against this house, and then we use that to go buy the next one cash or close to it, and then get a line of credit on that. So like our acquisition, like to buy something, we can do it quickly, right? Because you have cash. You don't have to deal with all the fucking bullshit.
Mhm.
But you have a line of credit with this bank, and then you're just continuing to add assets to it. So like this one bank who has our info, but we're constantly not upping the ante, but like just adding more collateral to our existing line of credit. You see, does that make sense how I'm breaking that down?
It does. It does. There's a question going to come down to what's the rate on the line of credit versus what's the rate on actual mortgage. I guess that'll
It'll
be
be more than a mortgage. It'll be less than some of this crazy national,
Yeah.
private investor money shit. It'll be
Yeah.
somewhere. It'll be the sweet spot, the Goldilocks number. You know what I mean?
Yeah, it won't be higher than 6.
Yeah.
Yeah. I mean, honestly, Chuck, that's not a bad strategy. Even though as much as it sounds like a Ponzi scheme, it's not a Ponzi scheme. As much as it sounds like a Ponzi
It's
scheme.
not a Ponzi scheme at all. It's
Whoa, I don't know why.
There's
Yeah,
real
bro.
property involved.
I know, but it makes
We'll do this on the
Edit that
regular.
out. Edit that out.
That's smart.
If
No, I mean,
that's
it's not.
that's
It's
as much
not,
a
but it makes
Ponzi scheme as
sense.
our healthcare. Shit.
Yeah. But at least that does two things, right? Like it removes the friction of us buying something, and then I think it makes a very strong negotiating thing. Like, hey, look, we're gonna buy this thing
Oh,
cash,
definitely.
right? And then like even if we get an offer, we can beat them up when we do the inspection. Like, hey, this, and this. Hey, I'm buying this cash, man. I got to make money. You know what I mean? Like that's just a different vibe. So,
Okay. So does that then does that mean how much more time and how much more money would we need to raise? You see what I'm saying?
We'll need
Right.
enough to buy the first place, because then we can borrow against the value of the first place for
yeah.
the down
This-
payment on the second
this-
place.
This property is for 20K, but they're 20K
No.
properties.
Yeah, nah, like that.
And if we got a line of
The
credit,
neighborhood's
we'll
going to
do
be
it.
trash
Okay.
before we have to put money into renovation. I don't think we want to.
20K is not going to work. It's too low. It needs to be at least like 70 something minimum.
Well, that's what we
Yeah.
have in cash, or they're about what we have in cash now.
So real
So-
quick, right?
Good.
Does any of this is it impacted by the fact that we don't have an LLC in said state in Tennessee, right?
Doesn't matter, right?
No,
Oh, I don't think
doesn't
matters.
matter.
It doesn't matter.
Okay.
Doesn't matter.
I mean, I
The-
just think it comes down to like just doing our normal thing, and then do we just do a boost round like every 6 months, every 4 months? I don't know.
Yeah.
Yeah, I mean, to Chuck's point, in a sense, it's almost as if, it'll take us longer to get that first spot. But once we get that first spot, even when we buy that first spot, we can actually, because you can right away buy a second spot with the line of credit. I don't think that would be that hard to get,
Just getting
No,
our first
it's gonna
spot.
be.
Yeah.
It's getting
Yeah,
the first
so-
spot.
You
Yeah.
can get a first spot right away, and honestly, the next month you can probably get a second spot.
So
I mean,
how I see it playing out is like, okay, however long it takes us to get to 70 or 65, somewhere close there, you get something, and then like you said, you do your paperwork, you get your line of credit. Let's say that takes another month. So now you have 70% of 70 is 50,000. We could do another boost round, right? And then we can go ahead and buy the next thing cash for 70. But oh yeah, the thing we bought for 70 generates income too. So we got an extra 1,000 in the pot as well, right? So it's like adding another few people to our group. So I think that could snowball pretty quickly. And then, yeah, it could put us in a position to have like a big ass portfolio relatively quick. And I just playing that out in my mind, I think that kind of offers us like the best path forward. I think it's just a matter of, I think that now the conversations that we need to have with lenders is, okay, what's your process for refinancing, or what's your process for getting to a line of credit, and then we'll take it from there. I'm imagining that the process will probably be the same, but again, as long as the process to boost your line of credit or increase your line of credit with more properties is basically as simple as, hey, let's do an appraisal. Like that should be what it is. Right. If I already have a line of credit secured by one property and I want more, it should just be an appraisal on this additional property, not like a ton of stuff, because ideally we'd keep going back to the same bank. They should have all of our info. They shouldn't need to do an additional credit check for all of us, because, it's all part of the same collateralized or secured line of credit,
Yeah, so let's say function how this plays out, right? So let's say you got a first spot for 75K, right? So boom, 75K cash done. And then you get a line of credit, say for $50,000, whatever percentage of that first spot that comes down to. I have 50K, right? So you take 50K and you can get another spot for, let's say you put 80% down the next spot with that the entire 50K. Boom. Now you have
that's the whole thing. You don't want to go down on the second one because you're gonna have, like, anything you put down, you're gonna have to go through that whole, like, coordination of buying all this and like getting all the kind of shit notarized. Like, we're trying to remove the friction of the purchasing process. So I'm thinking
you want to put cash down on the second one as well.
Yeah. So I'm thinking you take the line of credit for 50,000. Then all we have is a shortfall of 20,000 to get the next property. And maybe that takes us, 4 months, a couple regular rounds and a booster, whatever. Right. And then, now we have 2 properties that are, so it's our, our cash flow, our contribution, which is, I think, 1,600 a month plus 2 properties that are probably duplexes, right? That are bringing in 1,000 each. So now our monthly contribution is like $4,000. So, okay, now we can take a line of credit on that one. And instead of it taking 4 months to get the 20K gap, it takes us 3 months. So like the amount of time between properties should, the first one between 1 and 2 is probably going to be like, I don't know, 5 or 6 months, right? Especially if we do a boost. And then between 2 and 3 should be like 4 months. And then between 3 and 4 should be like 3 months. And then from there, it could be as simple as, like, at any given moment, we're just continuing to add properties one at a time or more at a time, right?
And in the interim, Chuck, interim and creating new LLCs as we go on, right?
Not necessarily.
I don't think you need to.
Okay, so everything will be under this umbrella.
I see what you're saying, because we had talked about different funding rounds. We talked about, I guess, Red Summer being a holding company and having different LLCs for each property. So I see what you're saying.
Yeah, in regards to like protection, maybe. I think, but I don't think we need to do that immediately. I think when we start, I guess, accumulating more properties, that's when we'd probably likely want to, truncate stuff and keep them kind of separated. Because like Ike was saying in the previous video, it's all about protection of the assets. If we have everything underneath one thing and shit hits the fan, then we could literally lose everything if everything's underneath one LLC.
So we'll have to look into it, but I wonder what the rules are, or what, there's got to be people who have the same problem as us, right? We're not the first people to come up with this. So I'm sure we just need to figure out what people do in this scenario. Is there a way, if the ownership is exactly the same group of people, to basically be like, hey, Red Summer 1 owns this property, but the parent of Red Summer 1, or sorry, my bad. The parent of Red Summer 1, which is Red Summer Holdings, is the one taking the loan. Because what we want is our lending power to be based on all of the assets owned by the holding company, but we want the paper of who owns this property on the county courthouse or whatever to be Red Summer 1. Because if you get sued, it's not who owns the note, it's who owns the fucking deed of the property that's going to get in trouble. You know what I'm saying? Like, if I get in a car accident, and Bank of America is my lender, like, they're not about, like, Bank of America don't have nothing to do with that. Like, I've got to have insurance. I'm going to be the one who gets sued for property damage and all that shit, or all that stuff. Sorry.
So I think I was talking to Ike and about this a while ago, right? That setup is where you have Red Summer as the umbrella company, and each one is like RSF1, RSF2, RSF3. And say Red Summer Holding is, say, in Delaware, right? And RSF1 is in, where Florida or, Ohio. And so each one is specific to where we're buying property. That was like the idea I was thinking, but it's RSF1 will be managed by Red Summer Holdings, the actual holding company. Yeah. Right. Yeah. And then the only one that really gets taxed is and everything is Red Summer Holdings. But I wasn't sure how to structure it. There's some really good videos online. But you have to talk to an accountant and a lawyer to set this whole thing up. But it's all like LLCs, like under LLCs and all of that.
Yeah, when we
Yeah.
originally talked about this, that's what we were thinking. And then we decided, because technically, which I even forgot when we were applying with the community bank, technically the LLC that we own right now is RSF1. It's not RSH. RSH we never purchased. I believe what we said, this is pre-recording our meetings. I believe what we said was that we're going to get RSF1, and then when we secure something under RSF1, then we can get RSH, and then RSH we can give the ownership of RSF1 to RSH, and then we'll have the two. As far as like the different, like, you know, incorporating in each individual state, that's only harder because well, I don't know if it necessarily changes anything. Like we have to pay state tax and property tax in each state that we have property in, right? And I don't know if the rules change because the ownership of the, I doubt they do. I'm pretty sure we can just get all of our entities owned in technically Delaware, and then they can own, so federally federally are, I don't know what the rules are or why they would be different from given states. That being said, though, I believe the idea was to get RSF1, then a property under RSF1, and then get RSH and have RSH own RSF1, and then start to own subsequent RSF2 all the way down. I think that's what we originally wanted to do. But as far as what Charles was saying, there's also the component. So we're basically doing it. We take more time initially to essentially be our own bank and bank our own properties from the jump. And then what we do is we purchase with cash, pull out a line of credit. So extend credit from the value of the property at a slightly higher rate, use that credit as cash to buy the next property. Then when we use that credit as cash, there's a step in between, you know, pulling out or getting a line of credit from that second property and either paying back or getting a third property, which is that we have to give back that line of credit that we've extended out from the first property. So that then the idea will be whether to refinance, like immediately refinance that property we just purchased with a bank. So it's like, instead of going to a bank and saying, we would like to buy property, we go to a bank and say, we have this property we want to partner with you on, essentially. So it's gives you more of an alpha stance when dealing with the banks. You're not begging. You already have secured the property. Now,
Yeah,
are you willing?
You already come with collateral. Yeah.
Yeah. So you name your price now, and then from
What
there, go ahead.
So I was just trying to think of like, how do we do this? And I remember us talking about the difference between general partners and limited partners. And I believe it is one of which is responsible and the other isn't, right? Mm-hmm. So I think the right answer here is, if we buy the property as RS1 cash, right? Mm-hmm. I believe what we could do is, when it comes time just to establish this line of credit, we could have RSH be the one to get the line of credit. And at that point, the property would be joint owned by RS1 as the general partner, which can get sued, and then RSH as the limited partner, which cannot get sued. Isn't that like the difference, right? Where like there's one group of partners who like is responsible and actually does stuff, and if something happens, they get in trouble. And then there's a limited partner who just, hey, I just contribute money. I don't actually do anything, right? Isn't that the difference between general partner and limited partner? Is that a voting power? Huh?
It's slightly different. So what you're talking about is the ability to make a move or make financial decisions, which is, yes, true, but more importantly, you know, a GP has voting power that an LP doesn't.
And does that voting power, because they're decision makers, does that also include responsibility in terms of if something went wrong? So like
yeah,
if,
I think it kind of does, right? I think
right?
so.
And that's what I'm getting at, because what we're trying to do is like cover all the bases, right? So there's so many things to consider. It's like, hey, we want to protect ourselves from liability if something goes wrong. We don't want one bad decision on one property to, you know, screw our whole portfolio. But at the same time, we want to use ownership of this entire portfolio to give us the most leverage when trying to establish lending relationships, right? So I believe if the limited partner is the one with all the money, aka credit, aka RSH, and the general partner is limited to just a particular property, I think, and this is where we got to consult with like pros, but like, or at least lay out the scenario to somebody who'd be more knowledgeable. I think that gets us what we want. So RSH has this line of credit against properties that it owns, right? Just like a husband and wife could own a property together, but off the strength of the wife's credit, they get it, or off the strength of or vice versa, right? But both people own it. So if we do that, I think that's exactly what we need to do. RSH has ownership in all these properties, and RSH has buying power. And then as we acquire new properties, each one is going to be a joint venture between RSH and then, 123 Main Street,
But what if
ABC
RSH
6
always
Street.
buys the place and you just do it? Is this just a transfer of ownership? I'm sure this is going to be some paperwork kind of fee, right?
Yeah.
And just transfer ownership. So RSH always buys it, and then you transfer it to RSF1 and then transfer to RSF2.
So I think you can
transfer
transfer.
as long as usually if you buy cash, yes, but if you have a mortgage, then it gets tricky because someone else owns that property too. So
I think exactly
cash
that.
for the first one, and I guess the second one too, right? But so that's what it's going to end up being, with the line of credit, which is a lump sum pretty much, and then whatever else we boost up to get a second property. So for RSF2, we can just have RSH buy it and just transfer ownership to RSF2, right?
You can't transfer ownership if you have if somebody else has an interest. Anybody who has an interest in the property has to basically sign off on you transferring ownership. So like if Bank of America loans me money against the house, it's my house technically, but I can't just transfer title to my brother, because Bank of America is like, I don't know your brother. I didn't agree to, you know what I mean? So that's the challenge there. And that's what I'm saying. I think if we buy everything as the joint venture, RSH plus brand new entity. So like the ownership is always these two people. Like they say, when you want to buy something, you pull credit off the strength of anybody who's at least a 20% member or whatever it is, right?
Yeah.
So, okay, they would pull credit of RSH, which should have something, and then RS1 or RS4, whatever, which doesn't have anything. But RSH is strong enough because RSH owns, 4 properties at that point. You see what I mean?
Yeah, I hear what you're saying. But the home equity of credit, right? So let's say you get off of RSF1, right? You get 50K off of that. The bank doesn't really care what you do with that money, because it's leveraged.
That's why the line of credit is so amazing, right? Like we're basically keeping ourselves from having to do a loan every single time we buy a property. That's the whole point. So
if you have that 50K, whatever, right? And then we raised 20 additional K from ourselves. Now we have 70K. We can just buy it ourselves again using RSH, and RSH can transfer ownership to RSF2, right? I don't think anybody has a say so. Like I don't think the bank doesn't care. It's because it's leveraged off of the property from the prior purchase, right? So I don't think they don't really have a say so on what you do with the money.
But what I'm saying is if RS2 owns the second one, when it comes time to grab a line of credit against that, we need RSH to be a partner in the second one still, so that you don't have to do the paperwork all over again. That's like the ownership. It's like
I see it.
Okay. Yeah. So the transfer, we don't need to do a transfer. We just need to have joint ownership. So each thing is its own entity, but the loans are always through the stronger financial partner.
Yeah, I see this.
So you're essentially kind of Chuck. What kind of saying that we kind of need to restructure the setup?
Yeah, because just think about regular property, right? Like husband and wife, married man and wife can own property, but the loan might only be through one person because that person is the one working. That's totally allowed. That happens all the time in business or any transaction. The person who's financially responsible just has to have a share of ownership. Who has what share is up to them, up to those people. So we could even say, hey, look, like, RS1 and RSH jointly own this property. The division of profit share and all that is described in the joint venture between RS1 and RSH. You see what I mean?
Real quick, so does anyone have a Bigger Pockets account? Maybe ask a question about multiple members trying to structure something like this. That's what people say.
I could do it, but I feel like this is such a it's a very detailed question to ask, and usually you get bigger pots is good for like very broad questions. Like this would have to go through like an accountant or a lawyer that is well versed in
I think by the time it gets to this point, when we're trying to buy a second property, we should talk to an accountant at the very least.
Yeah. Well, it's an accountant and it's somebody in the lending office, right? Because we're entering like creative financing with like, you know, liability protection. Like we're kind of entering this weird space where it's like, hey, this isn't documented in the handbook, but technically should this work, right? And then you need all the experts to be like, well, but I think it
or
should.
even just like an experienced mortgage broker probably would be able to give a good opinion.
Yeah, that's true.
Yeah, I have a
I have one question though about
Sorry,
some of the timing on it. Like, and I'm not sure this is so because I haven't done it myself, but I'm fairly certain that when you buy a property, even if you buy it cash, there has to be some sort of seasoning period between when you buy it and when you can go to a bank and, you know, get some financing on it.
Mm-hmm.
And then also, obviously, if you were to get that line of credit and purchase another property, to do any other sort of capital restructuring would require another seasoning period, anywhere from 6 to 12 months. That's what I've heard in different podcasts. I haven't tried any of this myself, but that's just something we have to consider, that the timing of it may be a little delayed if you do that way.
I want to say it's actually 6 months because you well, actually, no, I don't know, because if it's paid off completely, I don't know. Never mind.
Yeah, that's what I was going to say. I think the seasoning period applies, like seasoning between loans. Well, let me see how responsible you are with this piece of paper you signed before I'm going to let you, you know, enter a new contract with me. In our case, every time we buy something, it's straight cash, homie. So if I bought a property straight cash, I should be able to refinance it tomorrow.
Yeah.
Right.
Exactly.
Only thing to consider though.
I think that would only be in the case of if we're taking, you know, some sort of leverage.
Yeah, if we took a loan up front, I think there is seasoning. That makes sense. But like, just think about it from the bank's perspective or for any lender's perspective. Like, they always want to see, like, they want to see that you honor your agreements, right? Yeah. The agreement was, we buy this thing with cash. Okay, you've honored that. If the agreement is, hey, you loan me this money and I'm going to pay you back X dollars a month for 20 years, let me at least see you pay back X dollars a month for 6 months before I'll consider, you know what I mean? Like, it's always about your track record. I think the seasoning doesn't apply if you buy cash. So and again, each bank has their own rules, but you know.
Let me walk through the scenario then. So like, say, you know, we buy a property, 70K, and then, you know, turn around and get the line of credit on it. And then we use that line of credit as, you know, effectively the down payment or the lending portion, you know, aggregated with our down payment that we raise afterwards for the next property. So what's the next step after that?
We would buy that with cash, and then we would do a line.
That cash is including the line of credit from the previous property.
First one.
Exactly. Yeah. So on the line of credit that we got for 50K, we would have to pay back some, you know, we'd have to pay $500 a month for it, right? Because line of credits have a bill, whatever. But outside of that, we would buy the next property, 50K line of credit from before, or we'll call it cash, right? It's 50K cash, honestly, because when you have a line of credit, you pull it out, you don't need permission. You don't need them to vet you. It's yours, you know?
It's already been permitted, right?
It's already been permitted. Exactly. And the beauty of it is, as you pay it down, you don't have to ask again. It's just there for you whenever you need it.
Okay.
Right. Yeah. So at that point, step 2 would be take the 50 cash, take 20 more that we raise over the next, you know, few months, and then go buy another one cash, 100% equity already. Do it again, pull out 50K from that in a line of credit. Now we're ready to go buy the third property, 50K cash plus whatever we raise over the next few months. So that just keeps going. So the lines of credit for, you know, a subsequent property would be taken out and repaid for the previous line of credit. Is that what you're saying? No, I don't think you need to repay the previous line of credit.
Exactly.
I think we just go buy more property.
Well, because so you know, it is all cash, but then when we're taking another line of credit, they're going to look at our credit profile and see that it's not actually, because like when you're taking the next line of credit, they're going to do the same underwriting that they would do for, a mortgage basically, but it's a line of credit. And then when they see that, a portion of the current property that they're underwriting was in effect paid by credit, wouldn't they, not consider that cash at that point? Because to the previous bank through which we took the line of credit, yeah, it's considered cash because, a line of credit has that quality. But for the subsequent, restructuring, they're going to look at that as more of debt because we are paying debt service on it, and it couldn't necessarily be considered cash, I would think. And so I doubt that they would want to lend on that as if it was, a cash position.
I think that we would need
if it was
to
the same
pay back
bank,
the
I
lines of
think.
credit.
What's that?
I think if it was the same
Okay.
bank, they would. If it was the same bank, for sure, I think what Ike is saying certainly applies. A different bank might not know or care. But then again, if it's always a different bank, then we run into the same problem we're trying to avoid, which is having to do 8x the work every time, right?
Yeah.
I think that's how this
In
whole
between time,
scheme
though,
kinda
in
came up.
between time, we would need to be paying back the line of credit.
Yeah,
Because that's a bill.
And that's what, maybe I
functionally,
don't know.
it operates like a
maybe-
more. Think of it to us like yes, it's line of credit, but functionally, it's simply just think of it as a mortgage in a sense, right? We still have to pay it off with.
Well, that's why
a
you
monthly
refi,
payment.
right? There needs to be a
That's what I'm saying.
refi
Like,
situation between.
okay, property one is full cash, and then no longer is full cash because there's a line of credit on it, right? And then once we start spending that line of credit, then it becomes, a debt service. So that debt service is going to be used as cash for the next property, along with other cash that we bring in, but it's still a debt service in that we'll be paying, a mortgage on it. So when we go to not refinance, but pull a line of credit on that second property, and they see that, some debt is being serviced for the amount of money that we want to pull out as a line of credit, I think that might cause for some concern from the lender.
It all comes down to whether or not they need that whole thing paid back, or if they're like, well, we're giving you more lines of credit for 70% of a property, right? If we're not asking to finance the whole damn thing, we're not. So like we should, our numbers should still be okay, right? Because at that point, they shouldn't have to do credit pulls on everybody all over again. At that point, it's just, private money space where it's like, okay, well, what's the deal? What's the cash flow? What's your coverage ratio? What are your cash flows and expenses as a whole?
And it's backed by a real asset, i.e. RSH.
Yeah, exactly. It's backed by something real.
That we
something
paid
tangible.
actual money for. Which, yeah.
Yeah, I don't see where you're coming from. If we have to pay the whole $50K back first before we do anything else, then it's a moot point. But if we can just keep floating it because, hey, you're giving us more credit, but we're bringing in more collateral. And each time we do that, we're only asking for 70% of what the collateral is. So why not?
We potentially don't have to keep going with this quote unquote scheme. We could do it for the second place, right? And hopefully by the time we get it to, potentially by the time we get ready to do a third place, we could probably we'll have enough of a relationship built with this bank that we just can get a regular ass mortgage, because RSH will have better credit history. We'll now have at least one line of credit with them, which we're paying off. And we'll just say, we'll just want to put 20% down on a property at, whatever, 5%. And they'll say, sure, we have 2 properties with us. You're paying those off. Let's do that. And then it might be I don't think we will want to do this same thing for 10 properties.
Yeah, I honestly think that we should just do it no more than once, maybe twice, because I'm also concerned about over leveraging ourselves. Because let's say, God forbid, the market tanks, then we're gonna be in trouble with that. So I'm in agreement with Chuck, but not doing it more than once.
If we do it and in between time are able to stabilize the property that we bought with our home equity line of credit with a conventional loan after we've already purchased it, then we can do it one time over and over and over again. So this is the one time, this is the one time, this is the one time. You're just reusing that.
Yeah,
same...
but there are costs. That's when we refinance, right? I mean, there are costs associated with refinancing too, right? Which are
it's just, but Chima, Chima, it's the same cost that it would have been to search, like the cost that we're paying now. It's the same cost. Every time you're getting lending, it's going to be a cost.
Yeah.
Even
Yeah.
if
Even a line of credit costs the same amount to secure as a mortgage. It's effectively the same process. It's just that you don't have to start paying on the line of credit immediately because it's not being used until you start.
Exactly. And as you pay it down, you can use it again, right?
Exactly.
That's the other big thing. I pay off my property. You still have to go through some process to get money out of it again. With a line of credit, it's just there. So you pay it down, it's ready to be used again as soon as you are. That's the benefit of it.
Yeah, it's
And-
literally a credit card.
But,
Yeah,
is,
exactly,
I know, but is there any advantage to refinance and let's say RSF1, right? Whatever, you pull out 50K off of it. Is there any benefit then to refinance at that point? Or just
you pay back the credit, the home equity line of credit, and you pay it back at whatever the rate the conventional loan is versus the home equity. So let's say the home equity line of credit is 8% and you're able to get lending at 5%. So you borrow, so you already paid 50K, which is borrowed money, and you're borrowing at 8%. You get to repay it now at 5%, which is
I know, but I
loan.
thought we're under the assumption that the home equity line finance was going to be lower, right? Because we're saying
No, it's higher.
we're talking about
it's lower than the convention. It's lower than like your national
hard money.
Hard money.
Yeah.
It's lower than hard money, but it's still higher than conventional because conventional takes all this owner's information.
You're paying interest only.
Conventional is saying I'll borrow it to you at this lower rate because I have more assurance that I get that first you'll pay back, and second that I could go after you if you stop paying it back. That's why I need all this information from you. And then there's hard money, which is like the deal's the deal, and we'll just take the deal. If you stop, we'll just take the deal and figure out what we're going to do with the thing. And this is in between in that. Oh, go ahead.
So we buy the first place 75K cash, right? Boom.
Sure.
Right. And then we take out a home equity like a private credit on that first place. You're saying that that rate is going to be higher than we can get with on a mortgage for a national bank.
Yes,
it's going to be higher than 9%.
It's going to be higher, but it's going to be faster because you can effectively use it as cash. So there's no process in beginning where somebody else with cash might take the deal that you want, or somebody else with a conventional loan might take there's a time space. You're fighting against time with that arbitrage of interest rate, and then you pay it back. That's the difference with the worry that Zoe has with over leveraging. There's no over leveraging.
What did you mean,
here.
Chuck? When you said it was going to be in the sweet spot, like what did you mean by that earlier? Because I was under the assumption that it was going to be the rates are somewhat in the middle.
No, it's going to cost us more than a conventional loan, but it'll cost us less than hard money. So because we're in a lower price point, like Bank of America, Wells Fargo, they're probably not going to finance homes that cost 70K.
Yeah.
When they can finance homes that cost 200K for the same amount of, paperwork and effort. And you got to remember, they've automated all their systems. I'm sure they have their cost of like technology and all that is way, way, way more than, Landmark Community Bank in Memphis. So that's why we're having trouble finding these, like on a national program that'll loan against something this cheap. It's basically private money guys, right? It's going to be us, in 20 years when like, okay, we got 200K in a pot. Yeah, let's spread it around a little bit. Like that's what it is. So those guys charge a lot more for their money, but they can deploy it quickly. So from my mind, this strategy with like using lines of credit is it gives us the speed of like those private money people, but at least the rate is much, much, much lower. And we don't have to go through the onerous, application process that goes along with doing a conventional loan.
On the front end, Charles.
Yeah, on the front end.
So the difference is this is already my property. So now I'm just negotiating how I'm going to service the debt, as opposed to I would like to have this property. Can you please give me money? Now it's like, this is my property. So are you willing or not? If not, that's fine. I can service it by myself for a little less margin, but I won't die if you don't give me money. And that giving us the leverage when we talk to lending, it's like a leg up. And it's all because we waited longer and took more time for us to have more money in the beginning at the jump. So now when we need somebody to believe in us for really no reason, or the reasons we have, because we're all professionals, we all, not all of us, but we own property. Like we're already doing this effectively. We're just trying to do it at scale. So like we need to convince somebody to do that, as opposed to just doing it at scale and then say, this is what we're doing. So you can be a part of this. You see what I'm saying?
And it's like it's like somebody asking you for a favor or for help. And it's like, well, have you already done everything you could do yourself? It's like someone asking money for a business opportunity. Like, hey man, like I need $100 so I can go buy XYZ. It's a different conversation. It says, hey man, I bought XYZ. I need $100. If I don't pay you back, you can take this thing I already have. You know what I mean? Like it's just a different proposition. You come with a different, additional leverage. Like you've already done the first half, which is securing the property. In the previous example, when you want a mortgage up top, you're asking the bank to coordinate, giving you money, helping you secure a property, helping you value a property appropriately, establishing that, hey, title is actually accurate. Like all that stuff is already out of the way. Like when you buy something cash, you're going to do your title. That's going to be confirmed. It's ours, right? We're going to pay for that. We're going to pay for like the deed to be, clean and all that type of stuff. So, and really what it comes down to is I don't know their process. I don't know if I already have a line of credit against property. I don't know if adding another property to that same line of credit means, hey, all we need to do is pay for an appraisal and then they just add more money to our existing line. Or I don't know if that means we have to do like, all the whole credit stuff and all over again. I don't think we'd have to do all the credit stuff all over again because again, we're purchasing this as a business that cash flows. So they're going to care about the coverage ratios. That's my belief. I could be wrong, but even if we had to do all that stuff again, it still benefits us because at least we already have the property. It's already cash flowing while we own it. And, the paperwork and the arduous process, we've already got the thing. So it's already a benefit to us as opposed to we're putting in all this effort and we don't know if we're going to get the deal done anyways. It's just like, hey, if it takes us longer to pull money out or for the equity process, that's fine. We still have a fucking property,
Gotcha.
And the goal is to get as many properties as we can.
So do we have any, are we all in agreement on this,
That's the
plan
thing.
for the first one or two? Or is it worth a vote or should we, what are everyone's thoughts?
We should definitely vote, but there's things to consider with this, right? So like the present situation that we're in, we essentially have the funds that we need to be at this stage. And then there's building relationships and dealing with the owner's process of securing a property, finding a property that we decided and securing it. If we go to the scenario that we're talking about now, well, it'll take more time and it'll cost more on the front end, which will give us more time to do more research, but will also more than likely, lose the opportunity of securing these properties at whatever rate and whatever time. So there's that to consider. That being said, we were already ahead of time when we got to this point. And so this pivot grand scheme wouldn't be that big a deal, but it would take longer and be more expensive. At this rate, dirty math, we'll probably each need to put in $6,000 more over the next 6 months. That's $1,000 a month right there for it to come up to, I believe, 70,000 from where we are now. There's that. There's getting a $50,000 pot, which would be slightly less, probably be around $700 more a month up to that point to get to where we want to be and have 50K. But then there's the risk of what is 50K value in this region or whatever other region that we decide to look at. So there's all these things to consider when we're deciding on a vote to either continue on the way we're doing now or go on. I guess there's an in-between too now to think about it, which is like, continuing to converse and find national private lending options while we're on our way, and then continue to look at different regions, including this one, perhaps opening the price point up and things of that nature. But these are all things to consider.
Yeah. In a sense, I'd say, I guess a third option. Well, not a third option, but I keep doing what we're doing, right? Like you said. By the time we get ready to actually buy, we're going to have more in the pot, right? So, to your earlier point, would we want to put, say, 70% down on a place at the same price point at potentially lower rate, or use that to buy a better property at the same 20% point? And those are two very different strategies. Because if we were to say put 70% down on a property, and we'll probably get pretty good deals in terms of financing. and potentially still be able to do what Chuck said in terms of pull out some of that money, get a home equity line of credit, and for a second property potentially faster. We won't be able to do that though if we were to have the same money and we got a more expensive property because we waited longer. So different philosophies.
There's also the point too that if you buy, if you could, there's technically a way to, put 50% down. Let's say we have 50K and we want to buy a property that is worth, how should I say this? Basically, there's also a way to be engaged with a lender and have a home equity line of credit. But it's, there's pulleys and levers there too as well to think about. So like, securing a $70,000 line of credit, $70,000 property with 50K and 20% equity, and then, or 20,000 in equity, sorry, with 50,000 in equity and 20,000 in lending, and then pulling out a line of credit from that too. Obviously it's not going to be as much, but there's an in between. It's not just all this option or this option.
Hey, actually, I realize maybe I might have been explaining it slightly incorrectly. The line of credit is not on each property. The line of credit is for RSH, but it is backed by this property. There's a very, very different distinction there. When somebody pulls the credit report when someone looks at, such and such property, if someone looks at the owner RS1, they're not going to see that RS1 has any debt. If someone looks at RSH, they're going to see RSH has debt. I could go right now and get a line of credit secured by any piece of collateral. Some banks even offer unsecured lines of credit, right? That's essentially what a credit card is. If you mess up, they're not going to take anything from you. They're just going to take you to court. But generally, right, if you want big lines of credit, they want it to be secured by something. So RSH has the line of credit, which is secured by the property. It's not tied to the property like a traditional mortgage. It's just this piece of money that Landmark Bank or whatever bank is trusting RSH with. It's this bank trusts RSH with this amount of money. Just in case, we will take this piece of property if you don't honor the terms, which is, hey, pay back 6% of whatever you borrow. It's the line of credit pot that they're offering us is not directly tied to the first property in the traditional sense. I'm trying to does that make sense how I'm describing that? Yeah, it's a business line for RSH, but it is secured by this piece of collateral. It is not a loan against that collateral outright. Does that make sense?
Yeah.
It's different. So, and that's why I keep saying, I think to add more collateral to the line of credit, it might just be as simple as an appraisal. It is not, I want you to help me secure obtaining this property. I already have this property. I want you to give me a loan. Give me a loan. And if I don't pay back the loan, you get to take this thing that I have. It's not, I need you to give me a loan so I can go buy this thing. That's the difference there. And that's where I'm I think it is fundamentally different. It is fundamentally easier. And to raise this line of credit more and more and more, it's not commingling multiple properties together. It's bank trusts RSH. RSH says
that's sort of it's the way you just explained it. It's almost as if you're not necessarily going out and securing new lines of credit with each property. It's more just increasing the line of credit you already have, which can be done with a single institution. That's exactly what
I don't know. I think I wasn't clear in the way that I laid it out. That's what I'm talking about. It's one line of credit for RSH, and we're just getting them to increase it because we're letting them attach more things to secure it with. That's what I've been trying to say the whole time.
It's business credit as opposed to a home equity line.
That's my bad. That's what I was trying to articulate, and it just dawned on me that wasn't coming through.
So
because the way I understood it before, it seemed as if you were using the HELOC to buy another property, and then taking a HELOC on that property, which wouldn't be possible.
No.
It would be a HELOC on a HELOC.
Yeah, I was getting
My
That's
bad.
what I said was Ponzi scheme-ish in my mind.
It's
I was thinking.
no.
like
It's a business loan. It's a business loan which you can use for any purpose. But hey, this loan is secured by this
like
thing.
a credit card for RSH.
It's a secured credit card
Secured,
for
yeah,
RSH.
secured.
Yeah.
The only
That's what I'm
problem
talking
will
about.
be the rates on that credit card, right? Versus the rates.
It's gonna be
And that's what I'm
interest
saying.
only.
It'll be higher than a mortgage, but it'll be lower than some wild private money.
That's
But
So
it'll
then
be
how do we- so
flexible.
to take it
It'll be
to-
super flexible.
To take it to the next step, how do we start to establish the credit of RSH in order to start putting together that line of credit?
You buy property cash.
You buy a property cash and
Buy the
have some.
first one cash. Yeah.
Okay, that makes sense.
That's what it is. So, okay, I'm glad I said that because it was clear to me that wasn't coming across. It's a business line of credit for RSH.
Okay. Yeah. So we need to buy the first house then.
Well,
Mhm.
I think we still have to kind of vote on that, right? It's still, well, I think we're still at I think in those points, it's certainly well taken. Is it worth, if you have, let's say we have 70K, right? Do you want to buy a 70K house cash? Or do you want to buy a $140,000 house and put 50% down? Or a $300,000 house and put 20% down, right? So, I mean, it's,
I don't think we need to vote. I don't think we need to vote just yet. I think we need to find out if what I'm talking about is possible. I think it should be, but like, let's just confirm that it's possible. Like,
Charles,
so,
can
so
you like confirm that then? I don't even know. How to-
yeah. I mean, I think each bank's going to be a little bit different, but it's like, hey, I want a business line of credit. Period. You may secure it with property that I own. If I want to increase my business line of credit, may I just add more property to the list of things that are securing it? That's what we're talking about.
Yeah.
And if so,
I'm
do
with
I have
that.
to go through underwriting all over again? Or is it just simply a matter of, okay, we'll appraise this thing that you say we can secure our business line of credit with, and that's it, because we already know who you are. That's the difference, right? It's just like getting an increase, a line of credit increase on your Visa card, right?
Yeah.
Hey, once a year, I'm gonna ask you for more money, and you're gonna say yes or no based on my credit at that time. Well, in this case, we're gonna ask you for more money, and we're gonna say, forget my personal finances, it's irrelevant. Look at this thing I'm gonna let you take if I don't honor our agreement.
Yeah.
If assuming that that's the route we decide to take, where will we go from this meeting today? Because
Talk
I
to
will
lenders.
still be
More
looking at properties,
capital.
right? I still will take pictures. Yeah, we have to decide the structure of the next several months, how much more expensive it's going to be, and then what our timeline is for expectation of purchasing. And to be quite honest, we could open up regions again.
Yeah, and even looking at, but even looking at CPAs, right, to see how we can structure the entire entity so that it works smoothly with what we're talking about. And that could be a goal, right? Getting a CPA.
There's a few. There's talking to really a lawyer and an accountant. There's continuing to talk to lending options, continue to consider lending options, at least in this local area. There is continuing to consider price point, which probably doesn't change that much, because all it would be is that like something like Hunter is 65K. Under this premise, we'd be able to do that pretty quickly. So, and then there's understanding, well, I guess things don't necessarily change in terms of region, but they may over time. So so that will open it back up to, sort of a continuous looking at the regions we've looked at previously before that like passed the first tier of our analysis. And then there is engaging with now a tax and law specialist, and with lenders still too. We can talk to even more private, because like the thing about private money is that they're more flexible in their terms generally, because fewer people, it's less, they're not backed by the FDIC or anything like that. So they're more limber in how they're willing to engage with lending. But these are the things that we have to consider up to this point.
Yeah. What I guess my sense on how to move forward next, I think The good thing about this group is we're very forward thinking and trying to streamline processes even in the future before we actually have those problems in the present. I think presently, I think we're at a point where we have to just keep raising money. But I think looking for a national lender, even if we do agree, even when we say we're going to pay the first place with cash, I think a national lender who can extend a line of credit to us, I think we'll need that step anyway if we go that route for the second purchase. So I think that will be time well spent anyway, whether we end up using them to finance the first property or not, right? Yeah. So I think in the meantime, we'll just kind of keep doing what we're doing. The time frame, our initial time frame was by the summer, right? Was by the end of the summer.
We're about 4 or 5 months ahead.
Yeah. So the other thing, even though we said we wouldn't do it, one thing we could do is bring in an LP, right? So if, say, by the time over a 12-month period, we've all put in $20 a month, plus the 1 or 2 booster rounds, how much, let's say that came to like 4K or 5K, or how much that came out to per person. If we say, yo, person, do you want to be a part of this? Give us 5K now as an LP, right? This is our plan. This is what we're going to do. Full disclosure, would we be willing to do that with a couple people, if to say get us from 60K to 70K or whatever? And that's something we'll probably need to vote on, not this name, but at some point, if we think we needed to, if we decide we want to just buy a place and need a bit of capital boost for that first purchase.
That's cool, but like I'm thinking, what's their rate of return if they're putting in? This is our first property, right? And if they're putting in, like,
it has to be someone who's down to who's not going to miss that money right away, and who's trusting us to say, you know what, it's 5K I've put in, and we can guarantee them their 5K back over X amount of time, right? 5K back plus some over X time period. Say, we'll.
Over the last months that we've been doing this, our sweet spot, our minimum for cash on cash return is 10%. Now that's with lending. I don't know how that changes if we start to do our analysis, straight cash. But whatever it is, straight cash, they'll get the same piece of return that we expect to get. So the only difference would be that they're not a voting member. But and I think that's a good idea. I think that there's a little bit of a legacy that we have at this point in terms of content and our progress, even from when we started recording up to now, let alone when we really started before we were recording to now. But there's enough content and enough so you can see if you vibe with us, if you think that what we're doing is honest, transparent, makes sense, it's something you would do, because like it's the ideal person, Chima, that you're talking about is somebody who would want to do something like this, but understands that they don't have the 70K themselves, but they do have 5. You see what I'm saying? It's like an opportunity to be basically in the space at whatever your price point is to start, and somebody we know, obviously. So I don't think that's a bad idea at all. I think that the focus on it would be more towards the end, so we have a better idea of what it is we don't have, so we can go after that. But in the meantime, if anybody has anybody they're thinking about, just tell them the link and have them subscribe. Like there's plenty of legacy, or not plenty of, but enough at this point, definitely, to show like who we are, what we're up to, our progress, which has been considerable up to this point. And how we even come to decisions and pivot if necessary. Like we technically at this point have like opened up another arm. I wouldn't completely say pivoted, but we've considered the situation at hand and maneuvered without the need for a fucking vote, to be honest. Which technically in situations this will be where you need that, but like, that makes sense. That makes sense. That's a good idea. So I think that's less of a problem, as is, maintaining focus on what it is that we've decided we want to do, so that we're not wasting energy, basically. Because again, at this point, we honestly could purchase with lending or without lending, but it's like, is the reward worth the risk at this point for what we have and what we're trying to get?
Thank you for watching. Please remember to like, comment, share, and subscribe. Peace.